There's this common sentiment that I see online, people saying stuff like,
"School didn't teach me how to balance a checkbook or pay taxes, but at least I know the mitochondria is the powerhouse of the cell."
While in typical American fashion, a humble volunteer is here to pick up the slack where the school system failed you. Yes, you. Your tax dollars hard at work here, people. So for this series, I'm going to mostly be focusing on federal income taxes because in some ways they're what most state and local taxes are based on. They're what I have the most experience with, and I think that they're the most interesting personally. Furthermore, covering state and local taxes could get pretty complicated. If you're viewing or reading something containing info on federal income taxes from anywhere in the US, it will be relevant to you. But if I wanted to cover state taxes, I would have to make 50 different videos at least, and I don't have time for that kind of shenanigans. Well, technically it would be 43 videos because these states levy no personal income tax, but we're not going to worry about that. Furthermore, I'll be focusing on individual income taxes, so if you came here looking for business tax knowledge, this series is probably too basic for you anyways. So first things first, what are taxes and who pays them? Well, most of us are familiar with income taxes, and you may even know that there are also other forms of tax, such as property tax, sales tax, gift tax, estate tax, taxes on various business entities, taxes for when you die, and more. Income taxes are paid by anyone who earns income, obviously. This income can come from a job where you're an employee and receive a formal wage, income from owning your own business, income from investments, such as receiving dividends or interest income, and more. I want to take a quick second to mention that you'll probably use something like TurboTax, in which you just input the numbers from the forms you receive from your job, your university, or bank. These programs do most of the heavy lifting for you these days and are usually free for low-income individuals through the IRS's free file service. While you don't need to calculate your actual tax yourself, I still feel like it's valuable to learn how the underlying systems function. Of course, there are programs and calculators that are capable of doing complex mathematic calculations, but you still learned how to do algebra in school, right? Well, it's the same concept here. You need to learn how the underlying calculations function in order to understand how to interpret the results of calculators and software. So, how does the US tax system even work? The United States uses what we call a progressive tax system for federal individual income taxes. All this means is that the higher a person's income level, the higher their tax rate. You probably already knew that, but there are some common misunderstandings about this that I will explain. In the United States, there are what we refer to as tax brackets, which are simply used to determine what percentage you'll use to calculate your tax due. There are 3 different sets of brackets depending on what your filing status is. I'll cover filing status later, but for now we're just going to focus on the single, aka unmarried, filing tax bracket. As you can see, there are different income levels. These brackets change pretty much every year, and these are the rates that the IRS set for the 2019 tax year. Now, a lot of people misinterpret what these tax brackets actually mean. A lot of people might think that this means that if you make $39,474 a year, all of your income will be taxed at 22%, and if you make $39,475 a year, all of your income will be taxed at 24%. Luckily, this is not accurate. What this actually means is that all of your income within a specific range is taxed at the rate associated with it. The best way to explain this, I think, is with a quick example. So let's assume that you make $40,000 a year as your salary. The first $9,700 will be taxed at the 10% rate. The next $29,779 that makes up the second tax bracket between $9,700 and $39,479 will be taxed at 12%, and the remaining $525 will be taxed at 22%. All of this adds up to a total tax of $4,659. This is, of course, in contrast to if the whole $40,000 was taxed at the 22%, since it falls in the third tax bracket. This would end you with a total tax due of $8,800, which obviously I'm no mathematician, but even I can tell you that that's more than the amount that we came up with under the progressive tax system. Another consequence of this common misunderstanding is that someone might be hesitant to take a promotion just because they think that their tax will skyrocket, and the amount that their tax will increase will be more than their actual pay increase, leaving them with a net negative outcome. So for this example, let's assume that you were getting paid a salary of $39,000 and you get a raise to $40,000. Here is just a simplified version of our single filing status tax brackets for 2019, including the percentages associated with each one. And then adding in the $39,000 into the second tax bracket where it falls and the $40,000 into the third tax bracket at 22%. As we already discussed, you do not just take the $39,000 times 12% or the $40,000 times 22% to end up with your total tax. If you did this, you would end up with a tax of $4,680 under your $39,000 a year salary and a tax of $8,800 of your $40,000 a year salary. Obviously, this would mean that you only had a $1,000 increase in your income, but had a $4,120 increase in your total tax. Like I said, this is not accurate. Instead, your tax would increase from the progressive tax amount of $4,486 under your $39,000 salary to $4,658, since the additional income that you are receiving is all that is being taxed at the higher rate, and all of the income that you were making before is being taxed the same. This would increase your tax only by $172 as opposed to the $4,120 that we calculated in the purple example above. As you can see, obviously it's advantageous to take the promotion since you end up with more money in your bank account at the end of the day. So how are taxes collected? As you know, every pay period, a certain amount of taxes are taken out of your paycheck, and when you file your return in the spring, you usually can expect a tax refund. Let's go back to our previous example and say that you're making $40,000 a year. This means, of course, every month you would expect to make $3,333, but what actually ends up happening is your employer takes out $500, and the amount that actually gets deposited into your bank account is only $2,833. So what gives? The money being taken out of your paycheck is your tax withholding, monthly tax payments taken out of your paycheck by your employer and remitted to the government every month on your behalf. These withholdings are calculated using a variety of methods, including the IRS published withholding tables that also change every year. Of course, sometimes these withholding amounts are more or less than what your tax actually ends up being when you file your return in the spring. So, as I mentioned, every month for 12 months out of the year, your employer turns over $500 from your paycheck over to the IRS on your behalf, resulting in a total amount of $6,000 for the year. Now here's you, standing over here, ready to file your tax return with the IRS, hopefully before April 15th. As you know from the last example, you may remember we calculated our total tax due to be $4,658.50. Well, what gives? Your employer has been taking $500 out of your paychecks every month for a total of $6,000. This is way higher than the $4,658 that we actually owe to the government. This means that we now have an overpayment of $1,341 during the year. Luckily, after you end up filing your tax return, the IRS, and presumably a state and local government as well, will mail you a check for the amount of your overpayment, in this case, the $1,341. This is your tax refund for the year. Now, a lot of people look forward to getting their refunds in the spring. But what happens if your withholdings from your employer were not high enough to cover your tax liability? Let's say that for the same amount of income, your employer only withholds $300 a month for 12 months, resulting in a total amount of $3,600 remitted to the IRS on your behalf. This is obviously less than the $4,658 tax that you actually owe. This means that you'll end up with a $1,058 tax liability, and instead of receiving a refund from the IRS, everyone's worst nightmare, you actually have to send a check to the IRS. Now there's one more quick topic that I want to cover before we can move on to more complex concepts, and that is fines. There's probably two main fines that listeners will need to worry about. That is your failure to file and your failure to pay. For your federal income tax, that means the money that you pay to the IRS, excluding any money that you'll owe to your state or potentially your city, is what these fines apply to. Your failure to file penalty is 5% of your total tax owed. In our previous example, that is the $1,058 that you'll need to write a check to the IRS for when you file your return. Your failure to pay is only 0.5% of your tax owed. Again, that's the $1,058. Obviously, it is better to file and not pay than to not file at all. So if you don't file by the federal tax due date, which is April 15th, October 15th if you choose to extend, which I can cover later, you will be charged a $52.95 penalty, and that does accrue every month that your return is late. If you file but don't pay by the deadline, then that is only $5.29 penalty. Again, that accrues every month. Once again, I cannot stress this enough. It is always better to file even if you owe and cannot afford to pay. because you'll end up owing a lot more in the end if you choose not to file at all. I forgot to mention in the initial recording of this that the penalties actually do cap out at a maximum amount, but just don't even worry about it and file your return on time always. Now, if you choose to extend, it's really easy to do. All you have to do is file a Form 4868, and on this form, you'll just need to fill out how much tax you think that you're going to owe. It's really important, and I want to emphasize that this is an extension of time to file, not an extension of time to pay. And this might be a little bit confusing if you're not sure or if you've never owed before. If you think that you're going to owe, as in your withholdings aren't high enough, you will actually need to send a check to the IRS along with your extension request for the amount that you think that you're going to owe. If you just send in the extension request without any cash and you end up owing in October, you will be charged a failure to pay penalty for those 6 months that you didn't pay, even though you got a legal extension of the due date. That being said, I would like to warn against intentionally overpaying. Of course, no one wants to give the government more money, but you might think it's not a big deal since you're getting a refund. Just remember that this is basically an interest-free loan that you're giving to the government for no reason at all. If you are formally employed and you're concerned about it, you can always talk to your HR department to make sure that your withholding amounts are appropriate given your filing status and income level. Since this is a very intro level kind of series, I don't know if this will really apply to that many people listening, but I want to take a second to talk about other forms of payment besides just being a formal employee. If you are not formally employed and do not receive a Form W-2 every year, you obviously will have no withholdings. If you're self-employed and own your own business, you will have to pay quarterly estimated payments. For now, you can think of these kind of like withholdings that you withhold from yourself, but you send them directly to the government on your own instead of your employer doing so, since you don't have one. You may need to make estimated payments in addition to wage withholdings if you are employed and also own your own business on the side, or if you receive a significant amount of passive investment income, like a substantial amount of dividends. So in the next episode, I'll give a brief overview of what the tax return kind of looks like. I'm going to go through the Form 1040, its structures, its components, and all of the accompanying schedules that you'll need to file alongside of it. We'll also dive more into what a credit is, what a deduction is, and how they differ. I will also talk briefly about some tools that you can use to help you file your return successfully.